Geopolitical tensions continue to weigh on investors as events like the September 14th attack on Saudi Arabia's oil production test overall sentiment. So how should investors chart a course forward? With us now to discuss is Brandon Pizzurro, portfolio manager at Guidestone Capital Management. So shortly after the attack, we had a lot of people on that were talking about how investors were kind of complacent when it came to geopolitical risks and that we needed to reprice that. Have we gotten too complacent again that quick? Like, have investors already forgotten what happened earlier this month?
Good morning. Thanks for having me. I think that's a great question. There are a lot of people that tend to kind of sit back after these type of things happen and say, well, let's reassess, maybe, kind of overreact. And then it's almost like they completely forget about it 2 or 3 days later. So it seems like that cycle is almost shortened over time. I mean, it seems like an eternity ago that we actually had the global financial crisis. And there's plenty of people that don't even think about that at all. There's plenty of people in the business now that weren't in the business back then either. So, we always talk about the short-termism in the markets and how people forget about things. I think geopolitical storms are things that people, if they can kind of put their way past them for the day, they seem to be okay and sleep at night. But we would still say that there's something to be concerned about and taking that into account when you're allocating.
Brandon, when you hear the Saudi Crown Prince over the weekend suggest that prices could spike to unimaginable levels, what price levels could he possibly be talking about?
Well, what's unimaginable, I guess, could be anything, on the upside there. But what I would say is that, you get numbers over $100 a barrel. I mean, you're going to start to see some serious tension there. I mean, if you talk about even closer to 125, 150, that seems unimaginable. That seems like that'd be a lot. That'd be a big shock to the U.S. consumer. Consumer, of course, is about 70% of the U.S. economy. So you start putting some pain in the gas tank, and that would be unimaginable. And I think you could kind of categorize that as such.
Yeah, I think a triple-digit level is kind of what we need to worry about in that scenario. And whether it's 100, 125, it doesn't matter. It's triple digits rather than the high double digits. In any event, I think oil is a good play here because, the downside is capped. And the upside is not. That's the asymmetry you can exploit.
A lot of these stocks still seem really unloved in the oil patch.
Yeah. But you want to, in any commodity stock, you want to buy the lowest cost producers. That's just the way it goes. And I think in this country, at least in the US, you want to buy the shale fracking companies. So I would sort of talk about EOG, being the best in class. Stock has sold off a lot. Talk about decoupling. Oil is completely decoupled, from the rest of the market. That's a contrarian play.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.